Almost every VO versus SCHD comparison starts in the wrong place. People argue about dividend yield. They argue about which ETF grows faster or which one is safer. But none of that answers the question that actually matters. What does your life look like after holding one of these for decades? Because that's where most investors get surprised. The real difference between these two ETFs doesn't show up in the first few years. It shows up 30 years later when one portfolio becomes dramatically larger while the other sends a massive income stream into your account every month. So in this video, we're going to compare them the way a real investor should. I'm taking $100,000 and putting it into VO and SCHD. No extra contributions, no extra deposits, just letting time and compounding do the work. We'll look at what each ETF actually holds, how they grow, how much income they generate, how they behave when markets rise and fall. And in the end, you'll see something most investors never notice when they start. One of these ETFs could leave John with nearly $1 million more in portfolio value. The other could eventually pay over $18,000 per month in dividends. Same starting money, two completely different outcomes. Before jumping into numbers, though, it's important to understand something about money decisions. Investing never happens in isolation. You're making decisions while inflation keeps rising. Headlines keep changing. Markets swing up and down, and the future rarely feels certain. That's why investing $100,000 feels heavy. It's not just about getting a good return. It's about whether the decision you make today still feels right years from now. Some investors prioritize growth. They're comfortable watching their portfolio move up and down if it means the balance compounds faster over time. Other investors prioritize income. They want their investments to send cash into their account regularly, even if the portfolio grows more slowly. This is exactly where VO and SCHD split apart. VO is built for investors who trust long-term growth and can ignore short-term volatility. SCHD is designed for investors who value steady income and consistency. One strategy leans into patience. The other leans into reliability. Problems usually start when investors choose something that doesn't match how they actually behave. They pick the option that looks best on paper, then second guess it when the market tests their nerves. That's rarely a math problem. It's a behavior problem. And that's how good strategies fail. So before comparing performance numbers, we need to understand what you're actually buying. Because VO and SCHD may both be ETFs, but they were built for very different jobs. And that design choice explains why their results slowly drift apart over time. VO tracks the S&P 500, holding roughly 500 of the largest companies in the United States. When the biggest businesses grow, VO grows with them. There's almost no intervention. Companies naturally rise or fall based on market value. The fund simply reflects what the market becomes. That structure makes VO incredibly simple. It captures broad market growth and lets long-term compounding do the work. The companies inside VO are built for expansion. They reinvest heavily, they expand globally, and they prioritize growing earnings rather than paying large dividends. Most of their value comes not from cash today, but from what they can become in the future. That shows up clearly in the sectors VO holds. Technology companies, communication platforms, consumer innovators. These industries tend to thrive when the economy is expanding. That's why VO often performs strongly during long bull markets. But there's a trade-off. Growth-heavy sectors react quickly to interest rates and economic slowdowns, which means short-term movements can be unpredictable. SCHD was built with a completely different goal. Instead of owning the entire market, it selects about 100 companies based on dividend history, financial strength, and reliability. If a company stops meeting those standards, it gets replaced. The goal isn't maximum exposure. The goal is dependable income. And that shows up immediately in the types of companies SCHD owns. consumer staples, healthcare firms, industrials, financial companies. These are businesses people rely on regardless of the economy. Their earnings tend to be steadier, and their dividends remain central to the investment. That defensive structure changes how SCHD behaves. It usually doesn't rise as fast when markets surge, but it also tends to fall less dramatically during downturns. Speed gets traded for stability, and once you understand how differently these ETFs are built, the first place that difference appears is in the cash they send you. The first place investors usually notice the difference between VO and SCHD is dividends, because this is where the two funds clearly take different paths. VO does pay a dividend, but it's not the reason the fund exists. The yield sits around 1.12%. That income appears simply because many large companies pay dividends, not because VO is designed to generate cash flow. Over the last decade, VO's dividends have grown about 6.04% per year, which is respectable, but it starts small. In the early years, the dividend income is almost invisible. Most of the return from VO comes from share price appreciation, not the cash landing in your account. You usually notice progress by watching the portfolio balance climb. SCHD works the opposite way. Dividends aren't a side effect. They're the center of the strategy. The yield starts much higher at about 3.59%, which means income becomes noticeable immediately. But the bigger story is dividend growth. Over the last decade, SCHD's dividends have grown about 10.61% per year. That's significantly faster than VO. And that changes the role dividends play inside the portfolio. They're no longer a small bonus. They become a major driver of long-term returns. Cash arrives consistently, and when those dividends are reinvested, they compound into additional shares that generate even more income later. This creates two completely different investing experiences. With VO, dividends are easy to ignore for a long time. Progress shows up mostly through a rising portfolio value. Your account grows quietly in the background. With SCHD, dividends are impossible to ignore. Cash arrives regularly. Even during periods when share prices move sideways, the portfolio still feels productive because income keeps flowing in. And that psychological difference matters more than most people expect, because investing isn't just about numbers. It's about how comfortable you feel staying invested during uncertainty. Some investors are perfectly happy watching their portfolio fluctuate if long-term growth is strong. Others feel more confident seeing income arrive regardless of market conditions. But dividends are only one side of the equation. The other side is growth. And this is where VO begins to pull ahead. Historically, VO's price appreciation has averaged about 13.92% per year over the last decade. That growth doesn't happen smoothly. Some years are explosive. Other years feel disappointing. But over long stretches, compounding quietly builds momentum. Each gain stacks on top of previous gains. And eventually, the portfolio size itself becomes the engine of future growth. SCHD grows too, just at a slower pace. Its average annual price appreciation has been closer to 9.23%. That's still strong. But the curve of compounding becomes flatter. More of SCHD's total return comes from dividends rather than price movement. Growth still happens. It just isn't the main engine. Early on, this difference doesn't feel dramatic. A few percentage points don't seem like much. Year to year, the gap feels manageable. But stretch that difference across decades and something interesting happens. Compounding starts separating the two paths. The ETF growing faster slowly builds a larger balance. And the longer time passes, the more noticeable that gap becomes. To really understand what that difference means in real life, we have to stop looking at averages and start looking at actual periods of time, because investors don't experience returns as long-term averages. They experience them year by year while markets rise and fall. And that's where the contrast between VO and SCHD becomes much more visible. When you line up VO and SCHD across real time periods, the contrast becomes very clear because investors don't experience returns as long-term averages. They experience them year by year while markets move up and down. And that's where the personalities of these two ETFs start to show. Over the last 1 year, VO returned about 13.6%. SCHD during the same period returned closer to 4.5%. When large cap growth stocks gained momentum, VO moved quickly. SCHD stayed positive, but most of its return came from dividends rather than strong price movement. Stretch that timeline to 3 years, and the gap widens. VO gained roughly 71.9%. SCHD returned about 14.7%. This period included both market declines and recoveries. VO dropped harder during the downturns, but once the recovery started, it rebounded much faster and pushed to new highs. SCHD behaved differently. It absorbed less damage during the declines, but its recovery moved more slowly. The same pattern continues over 5 years. VO delivered roughly 79% total growth. SCHD returned closer to 33%. Again, the difference comes from how each ETF is built. VO holds companies designed to expand aggressively. SCHD holds companies designed to produce steady cash flow. One prioritizes acceleration. The other prioritizes reliability. Zoom out to 10 years, and the difference stops looking temporary. VO's price growth exceeded 255% across the decade. SCHD landed closer to 132%. That gap didn't happen overnight. It slowly built across multiple market cycles as earnings expanded and valuations increased. Living through those returns creates two very different experiences. With VO, the portfolio moves more dramatically. There are bigger gains, but also bigger swings along the way. With SCHD, the portfolio feels calmer. The growth is slower, but income continues arriving regardless of what prices are doing. And that leads to another important factor, because returns alone don't tell the full story. What matters just as much is how an investment behaves when markets get difficult. VO tracks the S&P 500, which means its risk profile closely mirrors the overall stock market. Its beta sits close to 1, meaning it tends to move almost exactly with market swings. When markets rise, that works beautifully. But when markets fall, VO falls with them. And because technology and growth companies make up a large portion of the fund, those declines can happen quickly. SCHD behaves differently during stress. It holds fewer companies and focuses on established dividend-paying businesses, consumer staples, healthcare, energy, financial companies. These sectors tend to hold up better during economic uncertainty. As a result, SCHD usually experiences shallower drawdowns. The price movements tend to feel smoother. And most importantly, dividends continue arriving even when prices fall. That difference may sound small on paper, but in reality, it matters more than most investors expect. Because volatility doesn't just affect numbers, it affects behavior. Some investors panic when their portfolio drops quickly, even if long-term returns remain strong. Others feel more comfortable seeing steady income arrive during rough periods. And that leads to another overlooked factor in ETF comparisons: not performance, not volatility, but something much more practical: how easily these ETFs actually trade in real markets. Performance usually gets all the attention, but there's another factor that matters just as much when real money is involved: execution. And this is where size and liquidity start separating VO and SCHD in a very practical way. VO is enormous. It manages roughly $1.4 trillion in assets. That makes it one of the largest ETFs in the world. SCHD is still large and well established at around $76 billion, but the scale is completely different. You feel that difference first in liquidity. VO trades millions of shares every day. Bid-ask spreads are extremely tight. Buying or selling happens quickly, and the price you see is usually the price you get. Whether you're investing a few $1,000s or moving millions, execution stays smooth and predictable. SCHD trades actively as well, but it doesn't have the same depth as VO. For most long-term investors, this difference won't cause problems. But when markets become volatile, spreads tend to widen slightly more, and very large orders can move the price a bit before they're filled. For small investors, this rarely matters. For institutions moving massive amounts of capital, it absolutely does. Fund size also reveals how these ETFs are used. Large institutions care deeply about scale and stability. They need investment vehicles capable of absorbing large inflows without distorting prices. That's why VO appears frequently inside pension funds, endowments, and institutional portfolios. It's designed to act as a core holding, a stable foundation that can handle huge capital flows without drama. SCHD plays a different role. Instead of being the base layer, it often gets added on top of a core portfolio to increase income. Institutional flow data reflects this behavior. Over the past 12 months, VO attracted roughly 3,100 institutional buyers. SCHD had closer to 1,700. That difference shows how often VO is used as a default building block for portfolios. Institutions rarely debate whether they want broad market exposure. They already know they do. VO is simply how they obtain it. The money flows reinforce that point. VO pulled in about $158 billion in institutional inflows, while seeing roughly $22.7 billion in outflows. Even after rebalancing and profit-taking, that still leaves enormous net demand. Quarter after quarter, inflows have consistently outweighed outflows. That pattern reflects long-term accumulation rather than short-term speculation. SCHD tells a slightly different story. It brought in roughly $17.3 billion in inflows and saw about $4 billion in outflows. The flows remain positive, but the scale is smaller and the movement more balanced. That lines up with how investors use it. SCHD enters portfolios when income becomes a priority, and it sometimes gets trimmed when capital shifts toward growth. Analyst sentiment shows something interesting too. SCHD currently holds an aggregate rating around 2.49, generally labeled as hold. Analysts covering most of the portfolio expect stable performance rather than explosive growth. The price target sits near $28.90, suggesting very limited short-term upside or downside. VO shows a similar pattern. Its aggregate analyst rating sits near 2.86, considered a moderate buy. But the price target also suggests minimal short-term movement. Analysts view VO less as a speculative opportunity and more as a long-term structural investment. Short interest confirms that view. For SCHD, roughly 0.16% of shares are sold short. For VO, the number is also extremely low. In both cases, the short interest ratio sits around 0.3 days to cover. And short positions have actually declined significantly in recent months. In simple terms, this means traders are not betting heavily against either ETF. Analysts may debate growth versus income, but the market itself shows strong confidence in the structure and durability of both funds. Now that we've looked at structure, volatility, institutional behavior, and fees, there's one final step, because theory is helpful, but investors ultimately care about something much simpler. What happens if you actually invest the money? So next, we're going to run a side-by-side projection, taking $100,000 and placing it into VO and SCHD, and watching how the two portfolios evolve over the next 30 years. That's where the real difference between growth and income becomes impossible to ignore. Now it's time to see what actually happens when money goes to work. Let's take $100,000 and place it into each ETF. No additional contributions, no extra deposits, just letting compounding do the work over time. With VO, the engine is growth. Historically, VO has averaged about 13.92% annual price appreciation, along with a 1.12% dividend yield growing roughly 6.04% per year. That means most of the return comes from the share price rising, not from dividends. So let's follow the numbers. After 1 year, the $100,000 investment would be projected to grow to about $115,040. By year 10, projections place the portfolio around $394,664. Now compounding begins accelerating. At year 20, the portfolio is projected to reach roughly $1.5 million. And after 30 years, the account would grow to about $5.59 million. But here's the key detail. Out of the $5.49 million added during those 30 years, more than $5.4 million comes from price appreciation. Dividends play only a small supporting role. Across the entire 30-year period, dividends would contribute roughly $80,000. Even after 3 decades, the income remains modest. The annual dividend would be about $5,081 per year. That's roughly $423 per month. The portfolio becomes very large, but it was never designed to generate income. It was designed to grow. Now look at SCHD. Its price growth assumption is lower, averaging about 9.23% per year. But the dividend side becomes the real driver. SCHD starts with a 3.59% dividend yield, and its dividend growth has averaged about 10.61% per year. That combination changes the math dramatically. After 1 year, $100,000 invested in SCHD would grow to around $112,820. By year 10, projections place the portfolio near $340,999. At year 20, it would reach about $1.22 million. And after 30 years, the portfolio finishes around $4.63 million. So compared to VO, the total balance ends about $950,000 smaller. But the composition of that return is completely different. Out of the $4.5 million total value, about $2.96 million comes from price appreciation. The other $1.5 million comes from reinvested dividends. Dividends are doing a huge portion of the work, and that shows up clearly in the income. After 30 years, SCHD is projected to generate about $215,998 per year in dividends. That's roughly $18,000 per month landing in your account every single month without selling a single share. So this is the trade-off. If you choose VO, the portfolio ends about $950,000 larger after 30 years. If you choose SCHD, the portfolio generates about $18,000 per month in income. One path builds the largest balance. The other builds the largest paycheck. Same starting money, 2 completely different outcomes. And the right answer depends on one question. How do you want your money to work for you? If you want to see how a simple dividend portfolio can generate $4,800 per month, starting with just $20 per week, click the video on the screen and I'll show you exactly how it's built.